You check your phone. Your bank app glows. There's a number on the screen, your mortgage rate. You assume it's about you, your credit score, your down payment. But the real answer is far stranger. That number was shaped in part by a retiree in Osaka deciding where to put her savings. It sounds like trivia. It isn't. It's a wire running under the floor of the global economy, connecting Tokyo to your kitchen table. Pull one end, the other end moves. What's pulling on your end? For decades, the Bank of Japan kept interest rates near zero, sometimes below it. Imagine paying your own bank just to babysit your cash. That was Japan. So Japanese banks, insurers, and pension funds went looking for yield elsewhere. The biggest, safest option sat 8,000 kilometers away. U.S. Treasuries, the IOUs of the American government. Here's the chain. A Japanese insurer can't find returns at home, so it buys treasuries. So does a pension fund. So do thousands of retail investors, nicknamed Mrs. Watanabe. Not one person, but shorthand for a generation trading yen for dollars to chase yield. More buyers push a bond's price up. Higher price, lower yield. Economists like Hyun Song-shin at the Bank for International Settlements have mapped how Japanese institutions supply dollar funding worldwide. That demand pushes treasury yields down. And most 30-year mortgages are priced off the 10-year treasury yield plus a markup. Lower yields. Cheaper money for you. Call it the Tokyo tide. A current of money rising and falling on the other side of the planet, quietly reshaping what it costs you to buy a house. The single largest pool of that money sits inside Japan's government pension investment fund, manager of retirement savings for tens of millions of workers, alongside major life insurers needing long, stable yields to match decades-out payouts. None of them set out to influence an American mortgage rate. They were just doing their jobs, at a scale measured in trillions. Why did Japan end up here? In the early 1990s, a massive real estate and stock bubble burst, and growth stalled for so long economists named the era the lost decades. The Bank of Japan pushed rates towards zero and held them there for longer than almost any other major economy, even buying bonds directly to pin long-term yields in place, a policy called yield curve control. One side effect: it pushed Japanese savers out the door, looking for yield anywhere else on Earth. Why cross an ocean for yield at all? Big investors hedge the currency risk, paying a fee to lock in the exchange rate. The wider the gap between US and Japanese rates, the more worth paying that toll. Shrink the gap, and the bridge gets quiet. In 2022, the Bank of Japan began loosening its grip on near-zero rates. Suddenly, Japanese investors had an option: stay home, where bonds finally paid something too. Carol Berteau, an economist at the Federal Reserve, has studied exactly how shifts in foreign treasury demand ripple into U.S. borrowing costs. If the buyers who held yields down start staying home, what happens to the price of money for everyone else? Yields go up. That's the twist. Your mortgage rate isn't only about the Federal Reserve. It's also about a fund manager in Tokyo deciding if the trip is still worth it. As U.S. rates climbed while Japan's stayed near zero, the yen weakened fast enough that Japan's government stepped into currency markets to slow the slide. Money leaving Japan for dollar yield has to sell yen to do it, and selling enough yen pushes the currency down. The same trade that helped your mortgage rate also made a U.S. trip pricier for a Japanese tourist. Two headlines, one cause. Robin Brooks, an economist who tracks this exact pipeline, has flagged what happens if that demand pulls back. Experts disagree on the size of the effect. Hedging costs and U.S. deficits tug the same rope. But the direction isn't disputed. When a major buyer of your government's debt changes its mind, the price of that debt changes too. That's the modern mirror. Every headline about rising bond yields, every loan quote half a point higher than expected. Part of that story may have started in Tokyo, not Washington. The Bank for International Settlements has tracked exactly this kind of cross-border flow for 2 decades. It isn't a secret. It's published research, sitting in plain sight, read mostly by economists. Maybe it feels hidden because the Fed raised rates is a shorter sentence than global capital reallocated after a shift in hedged yields. Simplicity wins headlines. It isn't always accuracy. Here's the takeaway. Your mortgage rate is a global number wearing a local disguise, quoted in dollars, signed at a local bank, tied to your credit history, and still shaped by money moving through Tokyo. You check your phone again, same glowing number, but you don't see just a mortgage rate anymore. You see the tide.